Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're building the ultimate patience portfolio through the core satellite strategy.
It is good to be back. And, the timing for this deep dive feels just about perfect. We're in a market right now where the old playbooks might not be working, but let's say the core equation of wealth, that hasn't changed a bit.
I do love an equation, especially one I can understand without a PhD. What are we solving for today?
We're solving for true wealth accumulation, and the formula our sources are putting forward is almost deceptively simple. It's wealth equals skill plus patience.
Wealth equals skill plus patience.
Yep.
Okay. I feel like almost everyone, myself included, obsesses over that skill part.
Yep.
Finding the next big thing, timing the market perfectly, reading charts.
Oh, absolutely. There's a whole industry built on selling you that skill.
Right.
And that's exactly the trap. The thesis we're digging into today is that the skill part, well, that can actually be solved pretty easily. You can almost automate it. It's patience that's the real challenge. That's where everybody stumbles.
So the plan for today is basically to engineer the skill out of the equation so we can just focus on, well, not panicking.
That's it, in a nutshell, yes. We're going to talk about how to reject these things the sources call sucker yields, those high payout traps, and instead anchor a portfolio in the proven outperformance of dividend growers.
Okay, let's get into it. Because before we build this solution, we have to really understand the problem. The sources brought up this one statistic that, it's terrifying. They call it the 90-90-90 rule.
It's a brutal number, but you have to see it to believe it. The rule basically states that 90% of new traders lose 90% of their starting capital.
Within 90 days.
Within just 90 days.
That's not investing. That's just expensive entertainment. You're basically lighting money on fire.
It sounds like an exaggeration, I know. But then you look at the actual regulatory data. On UK trading websites, think platforms like IG Markets, Plus 500, they're legally forced to show their clients' failure rates.
It's right there in the small print.
Right there. And it says that somewhere between 69% and 80% of retail accounts lose money trading complex things like CFDs.
And just for everyone listening, CFDs are contracts for difference, right?
Yeah.
You're not buying a stock. You're just betting on where the price will go.
Correct. It's pure high-leverage speculation, and the data is crystal clear. Almost 8 out of 10 people who try it are actively destroying their capital.
Because they're all in on skill and have zero patience.
Mm-hmm.
They want the thrill. But okay, let's flip that. Let's look at the boring option. The sources gave this super simple example. $10,000 into the S&P 500 10 years ago.
Just buying the index, no day trading, no frantic checking.
Just buy it and forget you own it.
That $10,000 would now be worth $33,120.
So you more than triple your money by doing nothing.
By doing nothing. And that brings us right back to our equation. Wealth equals skill plus patience. If you use a low-cost index fund, you've basically solved for skill. You've outsourced it. All that's left is for you to provide the patience.
But patience is so hard. It feels passive. And I think that's why this next idea, the core satellite approach, is so brilliant. It's not just an investment strategy. It's almost a psychological hack, isn't it?
It really is. It bridges that gap between the two warring sides of your brain. The I need to be safe side and the I want to get rich quick side. The analogy they use is a solar system.
Okay, I like that. Let's paint that picture.
So in the middle of the solar system, you have a massive planet. That's your core. It's the huge, stable foundation of your entire portfolio. It's designed for, sleep at night, safety, for income, for just preserving your capital.
So that's the anchor, the big, boring, stable planet.
Exactly. And then orbiting that planet, you have your satellites, the moons. These are much smaller positions, and they're more tactical. They're designed to do one of two things, either generate alpha or hedge against a specific risk.
Let's define alpha real quick. That's just a fancy Wall Street term for beating the market average, right?
That's all it is. The market return is beta. Anything you get on top of that is alpha. So the satellites are your designated place to try and be smart, to chase that alpha, or to protect yourself from something like, say, inflation.
So instead of a portfolio that's all in on risky bets or all in on boring bonds, you're building a fortress, the core, and then you have these smaller raiding parties, the satellites.
That's a perfect way to put it. It gives your desire for action a safe place to play without risking your entire future if one of your bets goes wrong.
I love that. Okay, let's build this thing then. Let's start with the core, the planet. The sources are really specific here. They don't just say buy an S&P 500 fund. They argue for something much more precise. Dividend growers.
And this is a really critical distinction. We are not talking about just any company that pays a dividend. We are talking about companies with a long, proven history of increasing their dividend payment year after year. The growers.
Why is that so important? I mean, what's the big deal between a company paying a flat dividend versus one that raises it a little bit each year?
The difference over time is just enormous. The data on this is frankly overwhelming. Looking from 1973 to 2023, so that's a full 50 years.
50 years. That's through oil shocks, dot-com busts, financial crises.
All of it. U.S. dividend growers returned 10.4% per year on average.
10.4%. Okay, and what about the broader market?
The equal-weighted S&P 500, just 7.9% over that same period.
Now, 2.5% doesn't sound like a huge difference year to year, but over 50 years with compounding.
It's astronomical. It's the difference between your money growing 14-fold versus just 4-fold. It is the engine of compounding.
But this is the part I found really shocking. Usually to get higher returns, you have to take on more risk, right? That's like the first rule of finance.
That is the rule. And the dividend growers break it. The sources show that over this 50-year stretch, these stocks actually had the lowest volatility of any group of stocks. Their standard deviation, which is how we measure price swings, was only 16.2%.
Okay, so wait. Higher returns with lower risk. How is that even possible? It sounds too good to be true.
It comes down to what the sources call the stamp of approval.
I like that phrase. What does it mean?
Well, think about a company's financial statements. A company can, let's say, creatively manage its earnings report to look better than it is.
Sure, accounting tricks. We've seen plenty of those.
Exactly. But you cannot fake cash. You cannot fake sending a dividend payment to a shareholder. The money either leaves your bank account or it doesn't. The check clears or it bounces.
It's the ultimate lie detector test.
That's it. A consistently growing dividend is proof. It's a signal of a healthy balance sheet, strong cash flow, and some kind of competitive advantage and moat. It automatically filters out all the weak, low-quality companies for you.
So the core is built. It's our fortress of dividend growers. Now for the fun stuff, the satellites. This is where we get to place our bets.
Right. And the sources lay out 3 main goals for these satellites: growth, downside protection, and alternative income.
Let's hit growth first. They talk about secular trends.
Yeah.
Just to be clear, that means long-term shifts that are happening no matter what the economy is doing, right?
Precisely. And the biggest one, of course, is AI. But the sources are very clear. Don't just chase the obvious chip makers that have already run up. That trade is, let's say it's a little crowded.
So if not the chip makers, then what?
You take a picks and shovels approach.
The classic gold rush strategy. Don't dig for gold, sell the shovels. Who's selling the shovels in the AI rush?
Infrastructure, specifically energy providers and engineering firms. I mean, these AI data centers are consuming an unbelievable amount of electricity. They require incredibly complex cooling systems.
It's becoming a real bottleneck, isn't it? The power grid can't keep up.
It is the single biggest bottleneck. So these utility companies, these engineering firms, they are the invisible backbone of the AI revolution. But because they're seen as boring, their stocks are so much cheaper than the high-flying tech names.
That's a smart backdoor way to play it. Okay, what's another growth satellite?
Reshoring. The idea that after decades of globalization, manufacturing is coming back to North America.
And the play here is railroads. I have to admit, that sounds a little old-fashioned. Are we really betting on trains?
It does feel a bit retro, I know. But
Yeah.
think about it. If you're making things in Mexico or the Midwest instead of China, you have to move all those goods across the continent.
You can't just build new railroad.
You can't. They have a total monopoly on their routes. It's a classic unbreachable moat.
Got it. Okay. And the third growth area.
Aerospace and defense. The sources say the sector has decades of tailwinds.
Yeah, unfortunately, the world just keeps getting more complicated.
It does. And you have this dual engine of rising defense budgets globally, plus a huge rebound in commercial air travel. These companies have orders booked out for years. The visibility is just incredible.
Okay, that's growth. Now let's talk about the other side, downside protection. The satellites you buy for when you're worried.
Right. And if your primary worry is inflation sticking around, that higher for longer world, the sources point to energy stocks.
Oil and gas company.
Yep. They argue they're still undervalued, but more importantly, they are a direct hedge against inflation. I mean, energy is an input cost for everything. If inflation is rising, it's usually because oil and gas prices are rising. Owning the producers helps offset that pain.
Makes sense. I saw gold mentioned.
Yeah, gold is an interesting one. The sources are careful to say it doesn't belong in the core.
Because it has no yield? It doesn't pay you to own it.
Exactly. But as a satellite, as an insurance policy, it's fantastic. If you think central banks are going to keep printing money and devaluing currencies, gold is the classic safe haven. It's your emergency asset.
Okay. Last satellite category. Alternative income. This one felt a little more inside baseball. They talk about private credit.
Right. Think of it this way. For decades, if a medium-sized company needed a big loan, they went to a bank. But after the 2008 crisis, new regulations made it much harder for banks to make those kinds of loans.
So banks pulled back.
They pulled way back. But those companies still needed capital. So a new group of lenders stepped in, non-bank asset managers, and they created this huge market for private credit.
And the sources mention specific names here like Blue Owl, ticker OWL, and Apollo, APO.
That's right. These are the big players who are essentially acting as the new bankers.
And why is that an attractive satellite?
Well, the yields are usually higher than what you can get in the public bond market, and very often the loans have floating interest rates. That means if rates stay high, your income from these investments also stays high. It's a different kind of income stream.
So we have the core and the satellites. But there's a huge macro picture here, right? Something is shifting in the world of money.
We are in what the sources call a regime change.
Sounds dramatic.
It is, in a way. The 2010s were all about zero interest rates and no inflation. That was a paradise for speculative growth stocks. But the 2020s, they're completely different.
Now we have inflation, we have labor shortages, deglobalization.
The era of free money is over. And that has created this massive, massive pile of cash that's just sitting on the sidelines. The number the sources cite is $6.4 trillion.
$6.4 trillion. I can't even picture that number. Where is all that money?
It's sitting in money market funds, basically in cash.
Because for the first time in 15 years, cash actually pays you something. You can get 5% doing nothing.
Exactly. But that 5% is tied to what the Fed does. And that is the trigger for what the sources are calling the Great Rotation.
Okay, walk me through the rotation.
Well, eventually the Fed is going to start cutting interest rates. And when they do, that 5% yield on your $6.4 trillion is going to start dropping.
So my say 5% becomes 4%, then 3%? I'm going to start looking for a new home for that money.
You have to. You need to replace that lost income. And where do you go? You can't go to risky tech. Bonds aren't paying enough. So where does that tidal wave of cash look?
It looks the core, the dividend growers.
It floods into high-quality, dividend-paying stocks. This wall of money could push the prices of these boring, stable companies way up as everyone scrambles for a safe, growing yield.
So the whole strategy is to get positioned in front of that $6.4 trillion wave.
That is the big picture argument, yes.
Okay, this all sounds fantastic, but we need to define the risk. And there's one huge trap here that the sources really hammered home. The sucker yield.
This is the single biggest mistake income investors make, chasing the highest percentage.
Well, it's so tempting, right? You see one stock paying a 3% dividend, another paying 12%. My brain just screams, take the 12.
And that's exactly how you get wiped out. A sucker yield is a giant dividend that's actually a massive red flag. It's a sign of financial distress, not strength.
How does that work? Why is a high yield a bad sign?
Because the yield is just a math equation. The annual dividend divided by the stock price. So if a company is in deep trouble and its stock price crashes, the yield percentage automatically shoots up, even if the dividend hasn't changed.
So the giant yield is just a ghost. It's an echo of a higher stock price.
It's a tombstone. It's the market screaming that it expects that dividend to be cut, and soon.
And the sources had a poster child for this, didn't they? The Global X SuperDividend ETF. The ticker is SDIV.
Oh, this is the ultimate cautionary tale. SDIV's entire strategy was to just buy the highest yielding stocks on the planet, no questions asked.
The strategy was literally chase the biggest number. So how'd that work out for them?
Over 12 years, the ETF returned a grand total of 3%.
3% per year.
No, 3% total for 12 years of waiting.
Oh my God. That's not even keeping up with inflation. You lost a huge amount of purchasing power.
And that 3% includes reinvesting all those supposedly juicy dividends. Over the exact same period, the S&P 500 returned 448%.
That is just. It's a financial black hole. All because you chase that double-digit number.
You chase the sucker yield. The lesson is just so clear. A sustainable, growing 3% yield is infinitely better than a flashy 12% yield that's about to get cut to zero.
It all comes back to that stamp of approval. A 12% yield isn't an approval, it's a fire alarm.
Exactly. You want the company raising its dividend because business is good, not the one with a high yield because its stock is in free fall.
So let's pull this all together. Final verdict. How do we mix this all together?
The synthesis is pretty clear. You build your foundation, your core, on those high-quality companies consistently raising their dividends. That gives you your long-term statistical advantage. That's your sleep-at-night money.
And then you layer on the satellites.
Right. You use those smaller positions to capture those big secular trends, AI infrastructure, reshoring, defense. You add some protection with energy or gold if you're worried. But you always keep those positions smaller.
And the absolute #1 rule of managing risk here.
Don't get suckered. Don't let that shiny double-digit yield lure you into a trap. If it looks way too good to be true, it is. It's not an opportunity. It's a mistake waiting to happen.
It sounds so simple when you lay it all out.
Simple, but not easy, because it requires that one variable we all struggle with.
Wealth equals skill plus patience.
It all comes back to that. And I'll leave you with a final thought on it. The math we looked at today is unambiguous. It proves that doing less, just buying and holding these dividend growers, makes more money than frenetic trading. We know that 90% of traders fail, so you have to ask yourself, if the evidence is so overwhelming, why is that urge to constantly tinker with your portfolio so incredibly hard to resist? What are you really addicted to, the results or the action?
Risk defined, portfolio protected.